RateScope here. Every few years, silver gets one of those moments where everyone starts whispering the same phrase: COMEX is running out of silver. Sometimes it's pure hype. Sometimes it's people reading charts without looking at the underlying data. But right now, we've got something different. Vault inventories down hard. Delivery behavior totally unlike normal years. A massive March futures position. And a key date, February 27th, staring us in the face. Today I'm going to walk you through the actual numbers behind the current silver shortage claims and the Feb 27th risk, so you can decide for yourself whether we're looking at just another internet panic or a real structural stress test for the COMEX silver system. By the end of this video, you'll understand how much registered silver COMEX really has now versus a few years ago, how fast it's being drained, how big the March open interest is, and how that compares to deliverable supply. Why February 27, first notice day, matters so much, and what data you should watch between now and then. This is for education, not financial advice. Always do your own due diligence. 1. How much silver does COMEX actually have? Let's start with the boring but critical part, the vault reports. COMEX itself tells you how much silver is in its approved vaults every day. The important distinction, which most headlines ignore, is registered silver, available for delivery against futures. Eligible silver, meets standards but belongs to someone else and is not currently pledged for delivery. As of now, registered silver is roughly 103 million ounces. That's the pile that matters when we talk about futures longs standing for delivery. Back in 2020, registered was more like 300 plus million ounces. So since 2020, deliverable COMEX silver has fallen by around 70%. Some people quote 400 plus ounces of total inventory by adding registered and eligible. That sounds huge, but it's misleading under stress. Remember the analogy: 12 cars in your garage, but 11 are your neighbor's Ferraris and 1 is your Honda Civic. If your bank asks what you can sell to pay a margin call, it's the Civic that matters. On COMEX, registered is the Civic. Eligible is other people's Ferraris. Right now, the Civic pile is about 103 million ounces. 2. How fast is that inventory being drained? Drops in inventory happen all the time. What matters is the rate. Compare. 2024, about 6.8 million ounces left COMEX vaults over the entire year. January 2026, around 50 million ounces left in just 1 month. That is roughly a 7 times jump in monthly outflows versus 2 years prior. On a daily basis right now, COMEX is seeing registered silver drain at roughly 785,000 ounces per day. That's almost 1 million ounces walking out of the system every single day. If that pace holds, over 3 weeks you're looking at 16 million ounces gone. Over 2 to 3 months you're talking about a major slice of already thin registered inventory. So we're not just dealing with normal seasonal withdrawal. The flow is abnormal and increasing. 3. What's going on with March open interest? Now pivot to the claims. For the March 2026 silver futures contract, open interest is in the ballpark of 429 to 500 million ounces equivalent. That's simply number of contracts times 5,000 ounces per contract. Side by side, registered, 103 million ounces. March open interest, 4 to 5 times that amount. This is the textbook fractional reserve structure of COMEX. The exchange is fine with many more paper claims than metal because it assumes most traders will roll or cash settle and never ask for bars. Only a small minority will stand for physical delivery. That structure is not automatically fraud, but it is fragile if behavior changes. 4. Why February 2026 is not a normal month. What makes this cycle different is how people are actually behaving with respect to physical delivery. Remember, February is not even the main silver delivery month. March is. Yet so far in February 2026 we're seeing delivery rate on the February contract of around 98%. Over 18 million ounces delivered already, and the month isn't over. That means almost everyone who can take metal in February is choosing to take metal. This isn't just silver bugs asking for 1 bar. These are hedge funds, trading houses, potentially industrial users who have COMEX accounts. Outside the exchange, they see retail and wholesale dealers quoting multi-month delays, Shanghai and Dubai trading at higher physical prices, lease rates, what you pay to borrow physical silver, spiking far above normal levels. So if you're a big player and you can buy paper silver on COMEX, convert it to physical bars through delivery, get faster access than through typical channels, it suddenly makes economic sense to use COMEX as a wholesale silver source. That is a very different environment from a quiet market where hardly anybody asks for metal. 5. February 27th. Why First Notice Day matters. Now to the date everyone keeps talking about, February 27th. That's First Notice Day for the March contract. What does that actually mean? On First Notice Day, any trader long March who wants delivery must be in position. After that point, the exchange can start assigning delivery obligations, pairing up longs who want metal with shorts who must provide it. It's the moment when open interest starts to turn into real delivery demand. Why is that a stress test? Because it tells you what percentage of March longs are just there for price exposure, and what percentage are serious about taking bars. Let's do some what-if math with simple approximations. Assume March open interest, 430 million ounces. Registered inventory by first notice, say 85 to 90 million ounces, after further drainage. If 5% of longs stand for delivery, 0.05 times 430 M equals 21.5 million ounces. 10% stand, 43 million ounces. 20% stand, 86 million ounces. At 20%, you're essentially using up nearly all registered inventory. Even 10% forces COMEX to deliver almost half its registered stock, or find ways to convince eligible holders to register and part with their silver, or use its rulebook to slow or redirect deliveries. Remember, February is already showing 98% delivery rate. It's not crazy to think March participants may also lean more physical than usual. That's why February 27 isn't just a random date. It's a reveal of how much real metal demand is hiding behind those paper contracts. 6. Does this guarantee a COMEX default? Short answer, no. Long answer, exchanges like COMEX have powerful tools to avoid an outright default. Cash settlement. They can legally pay you dollars instead of silver, potentially with a small bonus, and call the obligation settled. Margin hikes and rule changes. Raise margin requirements sharply to force out leveraged longs before they can stand. Impose position limits. Make some accounts liquidation only. Delivery management. Spread out deliveries over time. Quietly lobby or incentivize big players to roll contracts or accept cash. We saw versions of these tactics in 1980, Silver Thursday, when Silver Rule 7 restricted trading to liquidation only. 2011, when repeated margin hikes helped crush a strong silver rally. So, no, the math alone does not force a public default. COMEX and its clearing members will do everything they can to maintain the appearance of orderly markets. But here's what the data do mean. COMEX has much less registered silver than a few years ago. The rate of withdrawal has exploded higher. The percentage of people asking for delivery is unusually high. The paper leverage, open interest versus registered, is huge going into a key delivery month. That equals stress, not instant collapse. 7. How should you watch the next 30 days? Instead of obsessing over COMEX will die on February 27th, a more rational approach is watch the key metrics and update your view as new data comes in. The big ones. Registered inventory track daily or weekly. If it drops below, say, 80 million ounces heading into first notice, stress increases. March open interest. See whether it declines sharply as price moves, or whether it stays stubbornly high. If a lot of open interest disappears before February 27th, it may mean longs are de-risking or rolling. Delivery notices and percentage standing. In early March, after first notice, look at how many contracts actually stand for delivery. A very high percentage, like February's 98%, is a sign people want metal, not just a trade. Lease rates and physical premiums. Elevated lease rates tell you physical silver is hard to borrow. Strong premiums in places like Shanghai and Dubai show real-world tightness. If all four of these stay hot, low registered, high open interest or high delivery percentage, high lease rates, strong premiums, then silver shortage isn't just a narrative. It's the system itself telling you supply is tight. 8. What does this mean for you as an investor? Now, none of this is financial advice, but here's how I think about it. For long-term stackers, this isn't a reason to panic. It's a reminder of why you own physical in the first place. If COMEX stress causes short-term price dumps via margin hikes, those can be opportunities to add if your time frame is measured in years, not weeks. The store of value thesis doesn't live on COMEX. COMEX is just the quoting mechanism. For short-term traders and leverage users, this is a landmine field. If COMEX hikes margins 2 or 3 more times into March, you could be right on direction and still get force sold. Size small, know exactly where you're wrong, and respect the fact that rules can change mid-trade. For hybrid investors, you might want a core physical position you don't touch, and outside of that, a small paper/trading position for tactical moves. That way, if COMEX stress leads to a major repricing in your favor, you benefit through your physical stack, even if a futures position gets chopped around. The key is, don't let one date and one narrative push you into oversizing or over-leveraging. 9. Bringing it back to February 27. So where does that leave us? February 27 is not a guaranteed explosion date. It is the moment where March longs have to decide, do I want metal or not? The market starts translating open interest into real delivery demand. If delivery percentages stay extreme, like February's 98%, and registered keeps draining, we get closer to the point where the paper system either has to change rules more aggressively or allow more of the physical truth to appear in price. If, on the other hand, open interest quietly collapses, few people stand for delivery, inventory stabilizes, then COMEX gets more time, and silver's repricing may be more gradual. Either way, just screaming shortage or nothing to see is lazy. The data are out there. You just saw how to read them. If this video helped you separate signal from noise on silver shortage claims and Feb 27 risk, hit that like button, subscribe to RateScope, and drop a comment. What percentage of March open interest do you think will actually stand for delivery? 5%? 10%? More? This is education, not financial advice. Always do your own research and know your own risk tolerance. Invest with logic, not hype. RateScope out.